Imagine this. You check your bank account, your salary is there, your savings are there, your mortgage balance is there. Now, here's the question. Where did that money actually come from? Most people answer instantly, the government prints it. But here's the uncomfortable truth. In modern economies, most money is not printed by the government at all. It's created somewhere else, quietly, digitally, every single day. And once you understand who really creates money, you'll never see the financial system the same way again. Let's start simple. There are two kinds of money most people think about. Physical cash, notes and coins, digital bank balances, the numbers on your screen. Here's the shock. Physical cash is only a small fraction of total money. In many modern economies, over 90% of money exists purely as digital entries in bank accounts. So who creates those digital numbers? Not the Treasury, not the printing press, commercial banks do. And they don't create money by printing it. They create it by issuing loans. Here's how. You walk into a bank and borrow $100,000 for a house. The bank does not take $100,000 from someone else's savings and hand it to you. Instead, it types a new number into your account. Loan plus $100,000. Deposit plus $100,000. In that moment, new money is born, out of thin air, backed not by cash, but by your promise to repay. Let's visualize this. Picture a simple economy. Households, businesses, banks, a central bank in the background. When banks issue loans, businesses borrow to expand. Families borrow to buy homes. Investors borrow to buy assets. Every loan creates a matching deposit. That deposit circulates. It pays employees. It buys materials. It fuels spending. It raises asset prices. Money expands when credit expands. And when loans are repaid, the money disappears. Loan repaid, minus $100,000. Deposit removed, minus $100,000. Money is destroyed. So modern money is not static. It expands and contracts with debt. The government prints physical cash, but banks manufacture the majority of money through lending. The central bank? It sets the rules of the game, interest rates, liquidity, regulations, but it does not directly create most of the money you use daily. Banks do. Now ask a deeper question. If banks create money when they lend, what incentives drive the system? Banks earn interest on loans, so they are incentivized to lend, especially when asset prices are rising. Where does most new money go? Not into small startups, not evenly across society. It often flows into real estate, financial markets, large corporations. Why? Because those borrowers are safer and more profitable. This creates a powerful cycle. More lending, higher asset prices, more collateral, more lending. The winners? Asset owners, large institutions, those already inside the system. The losers? Wage earners without assets, young people entering inflated markets, anyone holding cash while credit expands. It's not about good or evil. It's about structure and incentives. Here's the part most people miss. Money is not created primarily to help the economy. It is created when someone takes on debt. That means our money supply depends on people being willing and able to borrow. If confidence is high, credit expands, money grows, markets boom. If fear spreads, lending slows, money contracts, markets crash. Financial crises are not just emotional events. They are contractions of money itself. This is why recessions feel like oxygen leaving a room, because in a way, it is. The system runs on confidence, collateral, and continuous borrowing. And when debt levels get too high, the system becomes fragile. So what does this mean for you? First, understand that money is credit-driven. When credit expands, assets tend to rise, risk-taking increases, optimism spreads. When credit contracts, liquidity dries up, assets fall, fear dominates. Second, watch incentives, not headlines. Interest rates matter because they influence lending. Bank behavior matters because it influences money creation. Third, think in terms of flows. Money is not just something you earn, it's something that moves toward assets, toward leverage, toward opportunity and risk. The system rewards those who understand where money is flowing. So, who actually creates money? Not politicians standing at printing presses, not governments shipping trucks of cash, but private banks, every time they approve a loan. Money is not a fixed pile. It's a living network of credit, trust, and debt. And once you see that, you stop asking, why are prices rising? And start asking, where is credit expanding? Because in the modern economy, the real power isn't in printing money. It's in deciding who gets it first. And that changes everything. If this changed how you see money, don't let this be the last time you question the system. Because once you understand how money is really created, you start seeing the economy differently in headlines, in housing prices, in market booms, in recessions. So here's what I want you to do. Comment below. Did you previously think the government created most of the money? And what topic should we break down next? Inflation, debt, central banks, or something deeper? Share this video with someone who still believes money just gets printed, because understanding money changes how you make decisions about it. And subscribe if you want clear, no-nonsense explanations about wealth, power, and how the economic system actually works. This channel isn't about hype, it's about clarity. And once you see the system clearly, you can never unsee it.